What would you say is the most underrated aspect of commercial real estate?
The most underrated aspect of it is probably capital preservation. It's like you're owning a hard asset. And if you own a hard asset, a building that cash flows and has a strong tenant in it, then you can't really do that with a lot of other investments, like you're investing in the stock market.
Welcome back to the Peak Profits Podcast. Today's guest is Zane Schartz, founder and president of Freedom Commercial Real Estate. With over 8 years of expertise in the private equity real estate investing, Zane and his managed portfolio of 6 commercial real estate funds and over 70 assets, totaling more than $700 million in assets under management. He's also a partner in $300 million worth of commercial real estate and directly oversees $175 million in commercial assets. Before real estate, Zane was a professional hockey player who competed for 3 years across North America and Europe after graduating from Liberty University with a degree in business marketing and management. He's also a partner and owner in Allen Americans, a professional hockey team in Allen, Texas. Zane's approach focuses on using innovation strategies to maximize investor returns and build lasting wealth through cash flowing commercial real estate with leases backed by multi-billion-dollar investment-grade corporations. Zane, it's a pleasure to have you on the podcast.
Thanks for having me. Appreciate it. That was a mouthful, but thanks for getting it all in.
Yeah, I figured we'd intro everything you do here in the start. Obviously, you're a big name on LinkedIn. You're doing a lot of great things in the real estate space, specifically the triple net lease world. So we would love to get into it today. As I mentioned briefly in the intro, you were a professional hockey player after graduating Liberty University, but you transitioned that into the real estate investing world. So can you describe that transition and how you got into the space?
Yeah, for sure. I mean, hockey was a huge part of my life growing up. It instilled in me like a work ethic and a drive and just a competitiveness that I think has been super beneficial in business. And, at some point, if we played sports growing up, all of your sports careers come to an end at some point. And I knew that. I kind of had the foresight in college to know that, hey, I'm not going to make a living playing this game forever. So let's figure out what we're going to do. So I started getting internships in different real estate firms, worked for a development firm, a brokerage firm, and a private equity group. Then I ended up working for that private equity group for 6 years. We grew from $100 million of assets to $750 million of assets. And I was the chief investment officer of that company. So had a lot of growth, had a lot of experience, and learned kind of under someone else's watch while building my knowledge and understanding of the private equity real estate investing space. After my time at that company, I said, hey, let's go start my own thing and do this myself. Take some investors, and we went and started a fund that really our focus is on creating the best, strongest, most risk mitigated portfolio that we can that cash flows from day one. So everything we buy cash flows from day one. We're really big on just risk mitigation, capital preservation, and creating cash flow to investors on a monthly basis, because every investor wants stable, consistent monthly distributions, and that's what we wanted to build, as opposed to, a lot of these apartment syndications typically take time to get your money back. So that's how I got into it. That's a little bit about what we do, but I'm sure we'll talk more about it.
Yeah. Can you just talk a little bit more about the mindset? You talked about like your work ethic and other things that you learned from playing sports. Like, which of those core principles have you taken from your sports world into business? Because if you look around a lot of professional athletes, they do naturally progress from sports into business. And there are a lot of tangibles that you learn through playing sports with teammates or even as an individual that you can apply to business. So there are like a few things that you think stick out the most. You mentioned work ethic as one of them. I think that probably does scream at the top, right? Your training, you're consistent day in and day out throughout your sports career. Like, which of those things have really stuck out for you in your business world?
Yeah, I'd say the thing that stuck out the most to me is competitiveness. Like, I just have a drive. And when you're a high level athlete, you always have to be competitive because there's people right behind you who, if you don't perform, they will take your spot. So from a private equity space, if I don't perform from a return standpoint and from delivering on what I say, there's 100,000s of other, operators out there who investors can take their money to. So my competition is other operators. What can I do to beat their returns? What can I do to find the best properties, to find the best debt, to get the best cash flow, to have the best diversified portfolio? So it's a puzzle that I get to put together and I get to piece together. And it's very competitive to say, what can I do to make it the best, even an inch better? Just like as in sports, I was like, what can I do today to get 1% better? What can I do to make this fund 1% better. So that's the biggest thing, is competitiveness. And the second thing I tell everybody is I learned how to lose. Hockey is a season of, between 50 and 80 games, depending on what level you're at. And you have to know how to lose. Nobody's going to win 100% of the game. So I learned how to lose and then, just regroup for the next one. One of my favorite quotes is, success is moving from failure to failure without loss of enthusiasm. So I know that I'm not going to win every single deal. I know that I'm not going to have the best deal every single deal, but I have to know how to learn from that and then roll it in to make it a better deal on the next one or a better opportunity on the next one. So I'd say those are the top two things that I learned and have taken into the business world from the sports world.
Yeah, I love that. I think there's a lot of correlation around, like you mentioned, either collegiate athletes and professional athletes that are transitioning into the business world, and kind of what you learn from a young age that transitions very smoothly into that competitive business type venture that every day you're competing, every day you're trying to get 1% better. And you seem to have done very well so far within your company and what you've done, growing these funds. So your entire strategy really revolves around acquiring properties leased to publicly traded investment grade corporations like Dollar General, CVS, and the like. Why did you choose this niche over, say, multifamily, self-storage, or other asset classes?
Yeah, so I'd say the short answer is it's consistent and stable. And, the long answer is I worked at a private equity group where we did value add multifamily. And some of those deals, there's a ton of variables in value add multifamily, value add storage, and developments. Just too many. There's a lot of variables that can go south. So I wanted to minimize the variables and say, okay, what can we buy that we know is going to cash flow from day one, that we know how long the lease is going to be in place, that we know what the cash flow is going to be. So when you buy a 10-year lease backed by a $100 billion company like Starbucks, and they are on the hook for 10 years, you know what you're getting for 10 years. So if you can do that and build a portfolio of 10, 20, 30 different properties, all with various, attributes that add to the fund, that's pretty awesome. And it's very stable and consistent and diversified. So for me, it was about financial freedom. The name of my company is Freedom Commercial Real Estate. And, to me, the best way to financial freedom is cash flow. And if you can have cash flow that's consistent and stable and you know what's going to come in every single month, that's what you can build. So that was why we did it.
I completely agree. And I think there's a lot of reasons why this space, the triple net lease space, is attractive. So can you also touch on what makes it different from a management side of things, with when you're talking about taxes, insurance, maybe some of the expenses and management aspects that you do within the fund, within these portfolio properties with a company like Starbucks?
Yeah, so a triple net lease has very minimal landlord responsibilities. And those are variables that we wanted to control going into it. So on taxes and insurance, you get fully reimbursed for taxes and insurance. So that's two less variables that you have to worry about going up. I know taxes go up every year, they get reassessed. Insurance is every year, you get reassessments as well. But for us, we know that we're going to get fully reimbursed by the tenant, so that doesn't affect our cash flow. And then from a management standpoint, like some of our properties are absolute triple net, where the tenant takes care of all of the common area maintenance, the roof repairs, the potholes, and those are kind of your preferred, leases. You pay more for those because they're 100% hands off. And then other leases are double net, meaning, the tenant reimburses for taxes, insurance, but they split the common area maintenance. And sometimes we might be responsible for the parking lot or the roof or something. Every lease is very different, but when you do your due diligence on the front end on acquisition, you're doing roof inspections, you're doing parking lot inspections. If there's a roof repair needed, you get a credit from the seller. So we are able to find ways to lower our risk for investors. And, been doing this now for almost 10 years. So I kind of understand what to look for and what we can do for investors for the best returns long term.
Zane, can you run us through one of your deals, almost kind of from the start of, you just mentioned there you do like a certain amount of due diligence, right? And then you have double net or triple net leases. Depending on each deal, it might be double or triple net. Like, can you walk us through maybe one of your most recent deals that you closed on, and kind of just talk us through that process that you go through from a due diligence standpoint on the asset itself, and then how you, like, the types of returns that people or investors can expect? And does that vary from a triple to a double net lease? Like, what are the pros and cons of a double versus a triple net lease? And that was a really long question. I'm sure there's a lot to unpack.
Loaded question.
Yeah.
But yeah, I can definitely answer it. So from a due diligence standpoint, like we look at a lot of things. These aren't as simple as I make them look to be, but they are more simple than multifamily or development deals. But we're looking at the underlying real estate, the dirt under the building, because when we buy this property, we're buying the building and the dirt, and then the tenant is paying our rent. So we own the building, we own the hard structure. So we're looking at what's the value of the dirt, is it on a hard corner? What are the traffic counts? What are the demographics? 1 mile radius, 5 mile radius population, median household income. Those are all important things for back end. We're looking at where's the nearest competition. If this is a, O'Reilly Auto Parts today, it's an 8,000 square foot box. But let's say O'Reilly Auto Parts doesn't renew their lease in 5 years. What could this be if it's not an O'Reilly? Where's the closest dollar store? Where's the closest drugstore? Where's the closest laundromat? All these different things. How big is the acreage? How big is the lot? Could this be bought by a developer and repurposed for something? What's the rent per square foot? What's the market rent per square foot? All these different variables that we're looking at. There's a third party software called Placer AI, which is a foot traffic. It tracks cell phone traffic in areas, and it shows how long somebody's been in a location. And you can compare it to other, for this example, O'Reilly Auto Parts across the whole country and where it stands in the, 6,000 O'Reilly Auto Parts across the country. So there's a lot we do on that end. Repurposability is probably the number one thing because that's our biggest risk is if the tenant doesn't renew their lease, what can we do to have a backfill tenant and or backfill rent? So, rent per square foot is a big one. And then from a return profile, every property is different. So, and when we acquire properties, we're kind of having different strategies on each, and that's why our fund structure is really good for us. So, for example, we might buy a brand new build, 10, 15-year Starbucks lease with, 10% rent increases every 5 years. But that's kind of just a yield play. We're not looking to do any type of value add because really the value of these properties, the value of these assets is in the strength of the lease. So the longer term the lease is, the more valuable it is, and the higher credit the tenant is, the more valuable it is. So if we're already buying a 15-year lease, we can't really increase the value. But here's an example of a property we bought in the past 12 months. We bought O'Reilly Auto Parts it had like 12 months left on the lease, and which is very short. So it had about a year left on the lease. I reached out to my contacts at the tenant and I said, hey, do you guys like this property? Do you like this? What is your likelihood of staying at the property? And they said, we like it. It's a good property. We're going to renew the lease. So I got it under contract as quick as possible. And as soon as we got it under contract, I started negotiating lease extension. So we negotiated a 10-year lease extension, and it increased the value of the property by almost 50%. So it went from, I think, $700,000 up to over $1 million in value. So 300,000. And then on our equity that we put into the property, we put about 300K in. So we'll double investors' money on that one in less than 12 months. But not every deal is that nice. I mean, a lot of our deals, like I said, we're not looking for variables that are kind of the home run returns. We're looking for singles and doubles. And if we can mix in a home run every once in a while, that's a huge win. So, every deal is very different from a lease standpoint. Every deal is very different from a return standpoint. And that's a good thing about being in a fund.
Yeah, that makes sense. And it sounds like a great win if you have some connections or some people inside of these, I guess, retailers or companies that you can make a call to. That definitely helps going into negotiations and or contracting and understanding the purchase. I guess some people might ask, why doesn't a Starbucks just buy that building or an O'Reilly's, right? That might be a common question. And so can you answer that quick?
Yeah. So the reason they don't buy the real estate is because it lowers their risk exposure. So if they don't own the real estate, all they have, their only, liability on the book essentially is their rent, as opposed to owning the property. And if they don't like a location, they can leave whenever they want. So their only risk exposure at that point is the lease in place. So let's say there's a Starbucks with 10 years left on the lease. If they don't like the location, they can they can't terminate their lease. They have to pay the next 10 years, but they can leave the location, stop operating there, and still pay the landlord for the next 10 years. But if they owned the real estate, they would then have to sell the real estate and the operation. So most big tenants across the country, across the US, don't own their real estate because it lowers their risk exposure. Obviously, some do, and they do ground leases, but for the most part, these national credit tenants are not in the real estate business.
Yeah, that makes sense too. And then I guess, have you ever run into a situation like that where a tenant had to leave for, I can imagine there's a bunch of reasons why, that you were still getting paid from a previous tenant and then worked to fill in and you're almost getting double rent in the sense?
Yeah, for sure. I mean, we have about 70 or 80 of these deals, so we're not perfect. But yeah, we've had tenants vacate and properties go dark, which means they're still paying rent, but they're not operating there. So then it's really on the tenant that is with the current lease. It's on them to go get a sublease, because if they can, let's say Starbucks is paying us $100,000 a year in rent, if they can go get somebody to subsidize their rent and say, hey, Wendy's, why don't you come in and pay $50,000 to us and you sublease to us being Starbucks, and then they have $50,000 less in liability. So we're still getting paid by Starbucks. They're still maintaining everything, but Starbucks then has a sublease. So that's actually good for us, though, if Wendy's does step in, because then we can go to Starbucks and say, hey, you guys owe us $100,000 over the next 10 years, which is $1 million. Why don't you pay us a buyout today of 50 cents on the dollar? You give us $500K today. Then we could work directly with Wendy's and say, hey, Wendy's, market rent at this store is at this property is $75,000. Why don't you guys pay us $65,000 and you get to stay for 10 years? And then we have a brand new 10-year lease with Wendy's. We just took $500K from Starbucks, and it's a win. That would be a perfect scenario in that case. So we've had that happen. We've had a property that was a Rite Aid. Rite Aid went bankrupt. Then we had a national gas station come in. They wanted the property. They scraped it down to the bones, to the concrete, and then they put on a gas station, and it made our investors pretty solid return. So best case scenario, not every scenario is that perfect. Sometimes you sit on a vacant building for a little bit and you wait for the right buyer. So that's where being in a fund and being diversified across 20 plus different assets really covers you, as opposed to being in one multifamily property where maybe, you're in a C-class multifamily property and somebody across the street comes and builds a brand new A-class property and they lower their rents to get their occupancy up and your occupancy drops. So it's just like, it's being diversified is really important.
You've mentioned a few times there, Zane, that you operate this as a fund. Can you just talk a little bit more about the structure of your fund, right? Like and how investors would ultimately invest through you and through Freedom Capital into that fund? Because you've specifically called out already like that this is why a fund is so important. So I really want the listeners to understand like what happens within your fund and what would they have access to. And
yeah. So the way our fund works is investors come into a parent entity, call it the fund, and then that fund goes and acquires various properties across the country, typically 10 to 20 different assets. And each of those 10 to 20 different properties has their own single purpose entity. And those single purpose entities roll up to the fund entity, which then cash flows out to the investors. So if you look at it from like investors come into this goes and buys properties 1, 2, 3, 4, 5. Those properties all are separate properties. They flow up to the fund and then back to investors. So that allows investors to have ownership. We also are able to pass through depreciation to them because they have direct ownership into the properties themselves. So we pass through depreciation, which is a huge tax benefit as well. So this is like, I don't know of anybody who does it like this on a private scale, especially with 100% investment grade tenants. Like that is our niche. Our niche is buying the best of the best tenants with multi-billion-dollar publicly backed leases. So, we're not buying strip centers. We're not buying retail centers. We don't want to chase rents from mom and pop nail salons, from pizza joints, from franchisees. Even if it has the name Wendy's or Taco Bell behind it, there could be a franchisee who has 2 or 3 locations guaranteeing that. And we want to touch that. We want the parent company be Starbucks, $100 billion company, Dollar General, $30 billion company. All these 10 to 100 to $200 billion companies are guaranteeing your rent. So when you're an investor in our fund, you get the properties backed by those and it flows up to you.
And do investors within the fund have the option to opt in or out of the properties, or is it you're investing in this fund and Freedom Capital, controls the properties that you are ultimately acquiring within the fund?
Yeah, so it's a blind pool raise, meaning they don't know the exact properties that we're going to buy. But there is a buy box, and it basically says, hey, investment grade tenants. These tenants could be XYZ or similar tenants, and it's going to be in these regions. But we don't know the exact properties that are going to come on the market. We don't know what's going to be on the market in 6 months, in 3 months, in a month. So we say, hey, these are what we're looking to buy. You're trusting freedom and our experience to build a portfolio that is best for investors. And with that, like I invest alongside all of our investors. I'm actually the largest investor in our funds. So with my own personal money. So, I mean, if you're an investor, hopefully that's, brings peace of mind to you because a lot of these operators don't put skin in the game or they roll in their acquisition fee and that's not real skin in the game. But we're all about investing alongside our investors because honestly, when I left my old company, the reason I started doing this was because I was going to start my own funds for myself. I was going to start buying properties, kind of buying a few a year and just building my own portfolio and saying, okay, I'm going to do this alone. And then I was like, if I'm going to do this with my own money, I might as well allow other people to come along for the ride, use my expertise and knowledge and experience to build my portfolio, which will also allow me more diversification. So I'm just pumping money into this because to me, it's the perfect investment for what I want. And if I can build a great investment, then I want other people to come along for it, which benefits everybody. So that's why I kind of did that.
Yeah, I love that, and I think it speaks volumes that you are the largest largest investor in your fund, which obviously just goes to show that you feel extremely confident in what you're doing, the operations you have in place, and the assets you're buying. And so, where are you guys targeting? Is it nationwide, and how are you sourcing your deals?
Yeah, so we target our properties in the Sun Belt. And the reason we do that is because our end goal is to roll up and sell to a private equity group or an institutional buyer, and they really like the Sun Belt. So we're kind of building with the end goal in mind, which could be at any point in the future. But so Sun Belt, really Texas, Florida, Carolinas, Georgia, Oklahoma, Arkansas, kind of Sun Belt region, Southeast. And then forgot your other question.
Sourcing, like, are you getting leads from brokers or just word of mouth at this point because of what you're doing, your reputation?
Yeah, so both. I'd say I've done at least a deal or two with every large brokerage firm in the country, and they keep bringing me deals. So I guess that speaks that we're good to work with. I'm really big on performing and delivering on what I say I'm going to do and not retrading. And I think hopefully I have a good reputation out there. I think from the amount of deals that get thrown my way, I have a pretty good reputation. So brokers is a big one. I mean, we shop on Crexy. Our analysts are on Crexy every day. We work directly with developers. Developers come to us and say, hey, we've got this deal coming. Do you want to, brokers aren't going to like this. You want to cut out the broker and just do a direct deal? And then we do deals with buyers with sellers who we bought from in the past. So those are kind of our three primary sources of deals is just on the market from brokers, off market from brokers or developers or sellers that we've worked with in the past, or I guess third bucket is sellers that we've worked with in the past. So that's how we source them.
And then you touched on briefly how the investors are allocated to the fund and it's a blind pool and you're just sourcing deals and buying them because of your expertise. And what is the game plan with the fund? Is there a certain projected hold period? Are they able to get out of the fund, because of the moving parts of like acquisitions and I'd imagine dispositions as well? Or is it they're in the fund through the life of the fund and then, the plan is to sell it to a larger institutional buyer?
Yeah. So this fund that we're currently raising for is first of all, it's for accredited investors only. Got to say that. But it is a roll up and exit strategy, being that we're trying to build the best fund that we can with the, strongest tenants, the best diversification and the, longest weighted average lease term that we can so that we can roll up and exit. That's our primary exit strategy. But we're also not opposed to just building a very strong portfolio, doing some cash out refinances at times of lease renewal and value increase, and then reinvesting those proceeds back into the fund to create a compounding yield effect. We've actually done that once or twice on the fund already. So our returns are augmented to higher returns for investors. And we can hold this thing for 5 years, 10 years, or we can sell it in 5 weeks if we get the right offer. So, we're kind of always looking for what's best for investors. Like we're literally talking with an investment bank right now to work on rolling it up and selling it. I'm talking with the family office out of Dubai to buy it. But if they don't give us the offer that we need, we're also still raising capital. So, like I said, I'm the largest investor in the fund. I'm going to do what's best to put the most money in my pockets, which will also put the most money in investors' pockets. So, from a timing standpoint, I think, anywhere from 12 months to 48 months. It could be a year to 4 years. It could be longer if it's not a good time to sell. We're very market driven on the exit. So if the market's really hot in 12 months, we'll probably look to sell. If the market is really soft in 12 months, we can hold. So that's a good place to be as an owner, is to have flexibility. We don't have our back against the wall. We don't have a construction loan or debt maturing on a certain date. We do use debt on our assets, but they typically have 4 to 7 years on the debt. So we have time, and lenders love these deals because they're getting paid essentially by $100 billion companies, and we use that to our advantage. And we bid all of our debt against pretty much every lender, and we say, hey, here's a 15-year Starbucks lease. What's the best you can do? And then we send it to this lender, and then we bid them against each other because they all want these loans because they'd rather have this than a 30-unit multifamily deal that's going to have wildly variable NOI. So we're able to get the best debt, we're able to get the best tenants, and hopefully build the best portfolio that will have a strong buyer on the back end.
I think it's so important to have alignment, Zane, between yourself, the business, and ultimately the investors. It goes such a long way. And like you just said there, you're going to do what's in the best interest of making you the most money, which naturally will also make all of the investors the most money as well, because you ultimately are the largest investor. You've now grown from your hockey career into managing over $700 million in assets. Like, what were the varying different inflection points? Like, that's a huge, huge number to be talking about. Like, what were some of the key lessons you learned early on throughout your process? What are some of the things that you would have done differently earlier in this journey? I know that you went through and you worked for a private equity firm, and you kind of learnt the ropes under someone else's guidance before going out on your own. But like, what would you share to other people that are going through this journey right now?
I would say I get this question a lot from like kids in college or fresh out of college. I would say like to always be learning and always be refining and always be improving. And, the cliche thing of always be improving yourself or 1% better every day, be the best version of yourself, like all these coffee mug quotes, but they're real. And if you can learn and, get smarter, and especially when you're younger, like getting paid to learn is a really good, thought process. Mark Cuban's book talks about getting paid to learn, especially early in your career. But for me, that's what I've implemented is the same ideologies that I used in hockey and sports to get better every day. Is like, hey, I got to learn every day. I got to refine my craft every day because this is a craft. And the better I am at my craft, the more investors will come with me. The better my returns will be for investors. The better I'll be for investors. And in the long run, it will be better. So I'd say like what I've learned is to just learn as much as you can. And then also to partner with right people. Like when you partner with people in business, one, you're with them for a very long time. It's typically, 3 to 5 year cycles, and you're with that person for that time. And you want it to be a good relationship. If you're an investor investing in somebody else, or if you're co-investing with somebody as a joint venture, like partnerships are hugely important. They're also important because they can, fill your gaps where you might be lacking, and you may not even know you're lacking there. So partnerships are huge, and you never know which partnership is going to open, the floodgates to exponential growth. So those are probably the two biggest things that if I could go back, I'd say focus on learning as much as you can, and then partner with the right people early and often.
Yeah, I love it. It's great advice. And people coming out of college, I think to your point, get paid to learn and try to go into as many different conversations. And, with the tools that are out there nowadays, there's so many ways to get information. It's almost overload. but put yourself in the shoes in the right positions to continue to learn and see what you're attracted to, or what kind of pulls at your interest the best. So with your fund currently, how many assets do you currently have in the fund? And you kind of mentioned the flexibility of the exit strategy. Do you have a plan to start a different fund with maybe the same strategy or a different strategy, just to kind of work off each other? Or what does that future look like for Freedom here in the
Yeah.
next
So
5 years?
yeah, the fund that we're currently raising for, we're probably going to close in the next few months. It's got 15 properties. We probably want to add another 5 to 7 before the end of 2026. And then, with that strategy, we'll probably look to roll up and sell maybe in the next, depends on the market, but we'll look to roll up and sell. And then once we do that, I'm sure investors will be very happy with the returns, and we'll go do it again. We'll just say, hey, if you want to come along for a ride too and take your, 100,000 that's now 160,000 over 2 or 3 years, like, let's go do it again. Let's roll that 160 and just keep doing it. And then, we'd like to potentially get into development and maybe building these properties and then like rolling them into the fund so that our basis is lower and our cash flow would be higher on our equity. So that's an option. And then, we might be looking to do like a blend of the two. Like, I kind of just said that, but a blend of development and cash flowing assets. So like maybe we build a fund of, 20 cash flowing assets, and then there's like 2 or 3 developments mixed in there to, augment returns even higher. So that's, I think, what would be the kind of the next phase or chapter for Freedom. But everything we do, we want to be like the best of the best. We want A class everything. So we've even looked into buying like A plus class, brand new build, stabilized multifamily, because a lot of our investors like love the triple net retail, but they're also like, hey, I've got X amount of dollars allocated to triple net retail. Let's do A plus class multifamily, where our return might be a 4% cash on cash, but I'm in a different asset class within commercial real estate. So I've had investors ask for that. If I get enough to ask for that, I might do it. But our focus is we want to build the best of the best, A plus class. Like, we're not trying to chase rents from C class multifamily or C class retail or C class storage. We want the creme de la creme, best of the best, and with high, with low risk comes lower return, and we're okay with that. We want our investors to know that their capital is safe. Capital preservation is probably most important to us. Yield is second to capital preservation, and returns after that are third. So Warren Buffett said, I'm more concerned about the return of my investment than the return on my investment. And that's something that I've taken to heart, and I say, hey, capital preservation is key, and we need to make sure that their money is safe and then that it's growing. So that's kind of the long-winded answer to the next 5 years, what we're looking for.
That's amazing. What would you say is the most underrated aspect of commercial real estate? Just throwing one at you from left field there, Zane. I appreciate that. That was completely random.
Yeah. No, I like it. The most underrated aspect of it is probably the capital preservation. Like, it's like you're owning a hard asset. And if you own a hard asset, a building that cash flows and has a strong tenant in it, then you can't really do that with a lot of other investments. Like, if you're investing into oil and gas, like, that can go to nothing. If you're investing in the stock market, that can go to nothing. If you're investing in a business, that can go to nothing. Like, we own, I guess the business could have assets, but we own a hard asset, a building that can always be sold for something. And, if it has rent and you have cash flows that are guaranteed for the next X amount of years by a company that has a magnificent balance sheet, then you're safe. So I'd say, like, how we do commercial real estate, I don't know a safer way how to do commercial real estate unless you're just banking it in land, which I don't even know if that's considered commercial real estate. But, just banking it in land is probably the safest way to invest in real estate, but there's no cash flow in land banking. So you're just banking on appreciation. So what we do is, like, we're buying strong dirt with rents backed by the biggest companies in the world. So that's I'd say, the most underrated thing. And a lot of investors don't understand that. A lot of investors just think, commercial real estate is like the same as all other real estates. It's kind of like, you just have a renter, but like our renters are multi-billion-dollar companies that are operating there, and they chose that location and they've committed capital to that location. And you're getting 20 different properties in this investment. So, it's a lot different than owning your own single family rental property and, having Airbnb potentially or something like that. So very different.
I think what you mentioned earlier about the tool that measures foot traffic, there's no way Starbucks has not done that on absolute steroids before deciding the location that they are going to put a Starbucks in place, right? You see them almost on every single corner here in New York. So like they know what they're doing for a reason. So if you've got them as a tenant, that should just double the kind of conviction that you have in the foot traffic of a certain asset when an organization of that size is putting their store there as well. So
I have a question then regarding like the roll up strategy and exit to an institution or a family office. You hear a lot about, the hot topic right now is small businesses or rolling up small businesses or the baby boomers transferring their wealth in the amount of small businesses that they own. How are properties like this valued? Is it based on the total NOI of the portfolio, and then they'll pay right based on cap rate or percentage of that? And what does that look like when you're looking to exit this type of portfolio to a larger buyer?
Yeah, I mean, that's exactly what it's going to look like. The exit would be, the total NOI of the fund, and then the cap rate that they're willing to pay for. And every property is going to have different leases, different lease terms, whether it be double net or triple net. Different, lease durations could be as short as 3 years and as long as 15. But it's going to be up to the buyer on the back end to kind of get their cap rate that they want to do it. But there's a lot of buyers, because when you think of this type of investment, let's say there's 20 properties across 5 different states in the Sun Belt, and if you're a pension fund who's looking for a 5% yield, but you can buy a 20 property portfolio that's yielding 6.5, 7, 8%, and it's backed by these multi-billion-dollar companies, and you don't have to do much management. That's our target buyer, is somebody who's looking to park money and get 5%, 6% cash on cash, in addition to the appreciation that will come through organic market appreciation, macro appreciation, and maybe through lease extensions. So, family offices who have, hundreds of millions of dollars, billions of dollars, and they're looking for just a little allocation into a $50 to $100 million portfolio that cash flows 6 to 7%. Like, those are going to be our buyers, and there's going to be a lot of appetite for these types of properties.
You've provided a lot of insight there, Zane. Where can people get in touch with you, with Freedom Capital? Like, here's a time, plug yourself as much as you possibly can.
Yeah. So I'm really big on LinkedIn. I like posting on LinkedIn. I like educating. I do a lot of educational posts on LinkedIn, Zane Schartz. And then you can visit our website, freedomcre.net, or you can email me directly and say you listen to me on the Peak Profits podcast. And my email is zane@freedomcre.net. And those are probably the best 3 ways to get in contact with me. And, if you want to learn more about how to invest with us, reach out. We can set up a call. We work with a lot of, our primary investor is a W-2 investor who doesn't have a ton of real estate exposure, but they're looking to get into the real estate game. Or we're looking for people who are high net worth individuals and do invest a lot in real estate, and they still have a W-2 income and are just looking for more exposure and maybe some triple net exposure into asset class that they're not in yet. So, we work with almost 500 investors, and, we work with anywhere from a teacher, a school teacher, to professional athletes, doctors, attorneys, engineers, everything in between. They're all looking for, diversification, because I actually posted something about this week on LinkedIn, but, with AI and how AI is taking over so many jobs today, I think like W-2 earners need to be prepping and preparing for creating different streams of revenue. If you aren't prepared to have your job taken by AI and have various streams of revenue coming in, you might be in a position where you could get hurt. Oracle just laid off 30,000 US employees in the past month. And, that's very sad. My hope is that everybody who got laid off had another source of income in their lives. Otherwise, their income stopped, but their bills kept going. And my advice to them is invest early and invest often in things that cash flow, because cash flow pays the bills every single month. And that's what we're building, is cash flow for investors.
I love it. What a great way to end the episode. Words of wisdom from Zane himself. If you don't follow him on LinkedIn, then go on LinkedIn right now and give him a follow, because I know we've been following him for some time as well. We've connected multiple times, and it was a pleasure to finally have him on our podcast. Obviously impressed by what you're building there at Freedom. Look forward to staying in touch and maybe partnering with you guys at some point here in the future. I know we have some shared investors with what we do here at 7P Capital, but we've been primarily investing into the multifamily space and the private credit, first position lien. But triple net lease is a very niche but attractive asset class for the many reasons that you outlined here today. So again, we want to thank you for coming on the podcast, and look forward to speak with you again soon.
Thanks for having me.